you. Good afternoon, everyone, and thanks for joining us. Can you hear me? Yes. So, good afternoon. I am joined by Elliott Harris, UN Chief Economist and Assistant Secretary General for Economic Development, and Ms. Dawn Holland, Chief of the Global Economic Monitoring Branch in the Department of Economic and Social Affairs. And they will brief you on the launch of the World Economic Situation and Prospects 2020 report. The report is the UN's definitive report on the state of the global economy. The 2020 edition warns of a broad-based deterioration, with world economic growth reaching its lowest point in a decade. Prolonged trade disputes and political uncertainty have both played a role in this slowdown. So, please, go ahead.
Thank you very much. Good afternoon, ladies and gentlemen. I'm very pleased to be able to present to you this afternoon this year's World Economic Situation and Prospects report. This is the UN's annual flagship publication on the state of the world economy, as viewed through the lens of the 2030 Agenda for Sustainable Development. The World Economic Situation and Prospects is a joint publication that benefits from the collective expertise of economists from across the United Nations system, most notably from the UN DESA, UN Department of Economic and Social Affairs, from the UN Conference on Trade and Development, UNCTAD, from the 5 economic commissions, the regional commissions of the United Nations, as well as other bodies such as the World Tourism Organization and the International Labour Organization. This year's WESP conveys a sobering message on the state of the global economy. In an environment of prolonged trade disputes and high policy uncertainty, the global economy slowed to its lowest growth rate in a decade. The world continues to face a host of risks and uncertainties, including trade tensions, escalating geopolitical conflicts, elevated levels of debt, as well as increasing climate risks. The risks of a further deterioration in the economic situation are high. Prolonged weakness in global economic activity may cause significant setbacks to the prospects for sustainable development, including the goals of eradicating poverty and creating decent jobs for all. Already, we see that the number of people living in extreme poverty has been rising again in parts of Africa, Latin America, and Western Asia. Amid growing discontent over a lack of inclusive growth, calls for change are widespread across the globe. Much greater attention needs to be paid to the distributional and environmental implication of policy measures. The deteriorating economic outlook has prompted monetary easing around the world. However, it has become clear that monetary stimulus alone is insufficient to revive the world economy. Further, additional monetary easing, can sow the seeds of financial fragility for the future. The number of countries at risk of debt distress has increased sharply. Meanwhile, with rising debt levels, the share of government revenue earmarked for debt service payments has increased in the majority of developing countries over the past decade. These rising debt servicing costs divert scarce resources away from the investment in areas such as education, health and infrastructure, which is so critical for the Sustainable Development Agenda. This year's WESP includes a special chapter on energy transition and the global economy. It underlines that the only way to decisively break the link between greenhouse gas emissions and economic activity is to move away from burning fossil fuels. Without a significant change in the energy mix, the goals of reaching net zero emissions by 2050 will be missed, and by a large margin. For example, global CO2 emissions would rise by over 250% if developing countries were to follow the same consumption and production patterns as have been followed in the developed world. The transition to a cleaner energy mix has the potential to bring not only environmental and health benefits, but also economic benefits for many countries. However, measures to compensate those who are negatively affected will be essential, both to protect the vulnerable and to safeguard the political viability of difficult but urgently needed policy actions. Member states of the United Nations have committed to a decade of action to deliver the Sustainable Development Goals by 2030. As we enter this decade of action, it is time to rethink economic policy making. A more balanced mix of policy is called for. Policymakers should move beyond a narrow focus on merely promoting GDP growth and aim instead to enhance well-being in all parts of society. This requires prioritizing investments in sustainable development projects to promote education, renewable energy, and resilient infrastructure. Countries should make use of available fiscal space to advance the Sustainable Development Goals. But even where policy space is tight, there is ample scope to improve the efficiency and the design of economic policies so that they are optimized to deliver the Sustainable Development Goals and to achieve sustainable, inclusive, and equitable growth over the longer term. Of grave concern is the long-term impact that prolonged trade tensions could have on the global commitment to a rules-based multilateral trading system. Many small developing countries would suffer under such a scenario. The global community must step up its collaboration and work together to resolve the challenges of climate, of international trade, and of mobilizing the financing that's necessary for sustainable development. I would now invite my colleague Dawn Holland to share with you more details on the report. Dawn?
Thank you very much. On the details of the report, according to our latest forecasts, world gross product growth slipped to 2.3% last year, and world trade growth essentially stagnated, marking the world's worst economic performance in 10 years. And we may see a slight uptick in growth to 2.5% this year. However, that is based on an assumption that geopolitical frictions do not intensify, that trade tensions do not re-escalate, that Brexit is concluded smoothly, that financial stability risks remain at bay, that climate shocks do not destabilize the world economy. A host of risks are facing the world economy, and any one of those could easily derail the recovery that we're forecasting for this year, and instead we could see world growth slowing to 1.8% this year. Why are we concerned about that? Well, prolonged period of weak growth obviously makes it much more difficult to make progress towards our goals like raising average living standards around the world, reducing poverty levels, and creating decent jobs. This year, we're expecting to see average incomes stagnate or decline in 1 out of 5 countries around the world, mostly in Africa, in parts of Latin America, and parts of Western Asia. In Africa, this is coming on the back of a decade of near stagnation in per capita GDP, although there have been some bright spots in the region as well, such as stronger growth in Ethiopia, Rwanda, Cote d'Ivoire. In addition to trade tensions and policy uncertainty, the effects of the commodity price downturn of 2014 and to 16 are still being felt in a number of countries. And in fact, we see that in 1/3 of commodity-dependent developing countries, average incomes today are lower than they were back in 2014. So while we're trying to raise average incomes across the world, in a large number of countries, they're still trying to catch up to where they were 5 years ago. And that includes a number of large economies, including Angola, Argentina, Brazil, Nigeria, Saudi Arabia, and South Africa. And this has also been allied with rising levels of poverty in the affected regions. Our report estimates that in order to eradicate poverty in Africa, annual per capita growth of close to 8% per annum would be needed over the next decade. And this compares to a woefully inadequate rate of growth of just 0.5% that we've seen over the past decade. So we're a long way from where we need to be. With the deteriorating economic outlook, a total of 64 central banks around the world reduced interest rates in 2019, marking the broadest shift in monetary policy since the global financial crisis. However, it is clear that this over-reliance on monetary policy is not sufficient to stimulate the investment that's needed to drive development progress. In fact, over the past year, investment growth has weakened in both developed and developing countries around the world. In addition, the ultra-loose monetary policy could pose risks to financial stability going forward by encouraging risk-taking and a buildup of debt. Global debt stands at more than 4 times the level of GDP and is at its highest level relative to GDP on record in developing countries. Allied to this, government interest burdens have increased in more than 70% of developing countries, and these rise in debt servicing costs are severely constrain the resources that are available to invest in development needs. This contrasts sharply with the situation in developed countries where historically low interest rates have continued to reduce government interest burdens. Around the world, investors are continuing to underestimate climate risks. This is encouraging investment, for example, continued investment in oil and gas exploration, an expansion of coal-fired power plants. And this is partly the result of policy design. So there are still subsidies that support fossil fuel use across the world. And the level of those subsidies is more than double the size of subsidies that have been put in place to encourage renewable energy sources. Carbon pricing is very limited, and where it does exist, it is usually the carbon-intensive sectors are either exempt or the levels set at the carbon price are far too low to deliver changes in behavior. This poses substantial setbacks to both environmental targets and also raises the risks of stranded assets going forward, which may leave governments and investors exposed to significant and sudden losses. Energy transition will have substantial social consequences, which will fall unevenly within and between countries. Big importers of fossil fuels stand to benefit from the development of local renewable energy sources, which will both improve their energy supply security and their external balance of payments. And meanwhile, some countries can expect to see increased demand for the resources, metal and mineral resources that are used in low-carbon technologies. But on the other hand, we have countries that continue to rely on fossil fuel exports to finance their government spending, to finance essential imports, and these face the risk of stranded assets and job losses. So the uneven nature of the returns emphasizes the need for cooperative and coordinated global policies to make the necessary progress towards energy transition. And finally, we're calling for a more balanced policy mix to stimulate healthy economic growth while moving towards greater social inclusion, gender equality, and environmentally sustainable production. To deliver this, strong governance and accountability mechanisms are needed to shift the focus of policy making away from short-term targets towards longer-term planning for inclusive economic development. Delivering on development goals demands a significant increase in investment in areas such as infrastructure, education, energy transition, and global uncertainty is the most important factor that has holding back that investment that we so crucially need to reach development targets. So remove that uncertainty by easing trade tensions, by resolving geopolitical conflicts, by clarifying environmental policy, and is the primary way that we can revive investment and move towards a stronger and more stable global economy. However, a further escalation of tensions and uncertainties would derail any expected recovery in economic growth. Thank you very much.
Okay, great. We'll take questions now. Please state your name and your media outlet over here.
Joseph Klein, Canada Free Press. You emphasize the issue of trade tensions in light of the signing by China and the United States yesterday of Phase 1 of their trade deal, the USMCA replacement for NAFTA, which the Senate is expected to ratify this week, Mexico has ratified it. Canada has yet to ratify it. I wonder, on that dimension, considering the de-escalation of some trade tensions, to what extent do you think that would have a positive impact on GDP growth? Secondly, fiscal. You didn't mention fiscal policies, and there seems to be a move in some developed countries, UK, at least the United States, and within the European Union, the remainder of the European Union, moved away from austerity towards stimulation. And third, I didn't see any mention of the productivity benefits expected from technology development, 5G, for example, and other productivity-enhancing technology developments. So could you just comment on those, starting with the trade developments? Thank you.
Thank you. Yes, indeed. The progress in achieving agreement to resolve some of the simmering trade disputes is a positive sign. And it will reduce some of the uncertainty that's been plaguing investment. It will certainly lead to a resuscitation of some of the trade flows. And we hope that that is strong enough to counter some of the decline, the weaknesses we've seen in the global economy over the last couple of years. But I would caution us not to assume that that has resolved all of the problems. There is an agreement in place. There is another agreement that's pending ratification. And those are progresses relative to the situation that existed. But let's not forget that that situation that existed is now being resolved outside of the multilateral rules-based trading system. These are plurilateral or bilateral trade agreements, and that is not the same as using the multilateral trading system with its rules to resolve trade tensions or trade disputes. And so we would caution against thinking that this is a positive development in all respects. We do think it is very important for the global community to come together and remind itself of why we created the rules-based system in the first place and what the advantages of that multilateral system are relative to bilateral or plurilateral arrangements between individual countries. I would like to talk a little bit about the question of productivity enhancements and technology, and Dawn, perhaps you can come back on that as well. But in one aspect of this is particularly important. It is that we are moving towards a digital economy which has tremendous potential benefits in terms of productivity enhancement, but also a possible downside, because not everyone is equally equipped to benefit fully from the potential advantages of the digital economy. And when I say everyone, I mean both individuals and groups of people within a country and countries compared with each other. For example, we are particularly concerned at the possibility that the digital divide that already exists between, for example, sub-Saharan Africa and North America or Europe, that digital divide will deepen and widen. And policy has to be put in place to avoid that, and international cooperation is going to be essential in reducing that divide, because with that divide and with the deepening of that divide, the possibility of entire countries or even entire regions being left behind cannot be ignored. And this, I think, is the key policy message that has to come from this. The technological innovations have the potential to greatly improve certain aspects of our economies, certain aspects of our societies, but without a framing reference that allows us to manage the way in which these technologies are deployed, we run the risk of exacerbating existing inequalities and failing to achieve the primary objective of the Sustainable Development Agenda, which is to leave no one behind. Dawn?
So I'll just come back on the question on fiscal space. Indeed, we've seen over the last year, there's been this excessive reliance on monetary policy to try and stimulate revival in the or offset the downturn in the world economy. We do think that there is space for more use of fiscal measures in a number of countries, and that countries can and should make use of that space where available. But also would say that even where fiscal space is constrained, because there are very high levels of debt all around the world, and a number of countries simply do not have the fiscal resources to hand to introduce such a stimulus. Even where fiscal space is constrained, there's ample scope for efficiency gains, for a better alignment between fiscal, industrial, and labor market policies, so that they're optimized towards delivering on our development goals. And particularly, we can just take the one example of coordinating on energy policy and moving them in the direction that has scope to both increase the available fiscal revenues by introducing, for example, carbon taxing, and deliver towards goals for a safer and better future.
Okay, over here.
Thank you very much, Errol Avdevic, Web Publica Press. Welcome, and thank you for this report on behalf of United Nations Correspondent Association. I just wanted to clarify a little bit, since I'm coming from Eastern Europe, obviously by my accent, but here is almost the trend that I'm seeing on this page that is totally negative going on for Eastern Europe or even whole European Union for 2020 and 2021. So can you a little bit address that? What kind of obstacles people in Eastern Europe are facing or in European Union? And also, since we journalists like to simplify as much as we can, if you can break down, who are the biggest losers and biggest winners of these projections that you gave us? Thank you.
Okay, I'll try and comment a bit on the situation in Europe. I would say that we still continue to expect most of the countries in Eastern Europe to grow at a more rapid pace than the rest of the European countries, as they have been doing for the past number of years. Manufacturing sector in particular has been held back by global uncertainty. And although domestic private consumption has been a bit stronger in Europe, but we have seen a significant impact of the global trade tensions, particularly in the manufacturing sectors across Europe. And that's spilled over, if you look, for example, at the automobile industry, that's spilled over across many of the countries are integrated into that network of production. And so there's been a significant impact of that on the slowdown. There's also uncertainties that relate to the evolution of Brexit, although I would say that that primarily that impacts the United Kingdom itself, although there's a risk that it could have more negative consequences for other countries across the European Union as well. But we are expecting to see some modest rise in GDP growth in the European Union this year compared to the slower growth that we saw last year. So in aggregate for the European Union, we see growth accelerating from 1.4% in 2019 to 1.6% this year. For what we call the EU 13, so that's the 13 countries joined since 2003, the comparable numbers 3.8% for 2019 and 3.3%. So a considerable margin above the other parts of the European Union.
Can you say that Eastern Europeans are winners? Or?
I find it hard to say to comment on that. I'm sorry.
I don't think that's the right choice. I don't think that's the right choice of phrase or terminology. It's not a competition between countries. It's some countries have had a stronger economic performance, but not at the expense of others. So winners and losers might be inappropriate choice of words.
There are not winners and losers in global economy.
There are winners and losers in some of the developments. For example, in the shift away from the fossil fuel industry, there will be those who lose out. But in the case of relative growth performances, I don't know that we want to call it a winning solution as opposed to a losing solution, because they're not gaining in economic performance at the expense or taking away economic performance from others.
Okay. Back there, please.
Hi there, Toby Burns, NHK. Certain policymakers in the United States have characterized what you deem an excessive or an over-reliance on monetary policy and quantitative easing as we should be thinking about this, according to them, as a new normal. I'll read a quote here from one of the board of governors of the Federal Reserve System. A key feature of the new normal is that the neutral interest rate, the level of the federal funds, blah, 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 appears to be the level of federal funds that is consistent with the economy growing close to its potential rate, full employment, and stable inflation appears to be much lower than it was in the decades prior to the 2008 crisis. Do you agree with this assessment? Because it seems to be like just the opposite of the worldview that you're proposing. And how do you reconcile this? That's it.
I think the essential part of our analysis is that there is an over-reliance on monetary policy, which has proved not up to the task of reviving the global economy. We see interest rates that have been very, very low for a long period of time, in some cases dipping down into the negative areas, and yet we do not see the expected, if you will, increase in investment activity. And so clearly, the fact that you have an accommodative monetary policy has not been enough to overcome the reticence of investors, which, in our view, is very directly linked to the policy uncertainty in the frameworks that they're confronting. So our policy message here is that it is no longer enough to consider that monetary easing or quantitative easing or some sort of loose and accommodative monetary policy stance is going to be enough to get the globe back on track to achieve the Sustainable Development Goals. It just isn't enough to spur the investments in sustainability that we need to see. And this is why our policy recommendation is for a better balance in the mix of policies, that even if governments think that there isn't enough fiscal space to do something really radical or to engage in a stimulus, there are still ways in which you can formulate policies that are more effective, more efficient, and more consistent with the objectives of spurring investment in the right sorts of things.
So do you think that's a misleading characterization then on the part of that specific policy body?
He may have been referring to the monetary policy situation right now, and to the fact that we have had this situation for a long period of time. But that is not the same as the type of analysis that we're trying to make, which is in the context of, are we achieving enough economic performance to allow ourselves to be confident that we'll reach the Sustainable Development Objectives? Thanks.
Thank you. Nabil Abisab, Al Arabi TV. You talked about the climate change impact. Can you be more specific regarding the Middle East or West Asia area region? And if you have also numbers or information about the biggest losers and the least losers maybe in that region.
We do have some figures in the report that looks across the world at where the fossil fuel assets are that are likely to have to remain unburned in order for us to reach climate targets. And the Middle East does feature highly in that illustration. I can give you a couple of figures if I can spot it. And saying that, most of the countries that are reliant on oil exports have been building up these large sovereign wealth funds over the last many years, which can act as a cushion in the transition process to offset some of the negative consequences of losses of income that can be expected. So let's see. So in terms of oil reserves, it looks like it's about 60% of global oil reserves that are likely to remain unburned are located in the Middle East, and just under half of the gas reserves. Commonwealth of Independent States is the other area where gas reserves are particularly high. And for coal reserves, we have the United States, China, India, and also the CIS as well. So those are the countries that are most exposed to the stranding of assets going forward. What we recommend is good management of revenues now, so that there is these transitional funds in place to help ease the burden of diversifying the economies towards alternative sources of production and revenue.
Okay, any further questions? Okay, thank you very much. That concludes our briefing. Thank you.